Hello everyone. We are still on the theory of capital structure and majorly on the theories of capital structure. Basically, we are examining the traditional theory of capital structure and the M&M theory of capital structure. That is measuring the level of debt in the capital structure of the company. How does it affect the value of the company? Does it even have any effect on the value of the company having debt in its capital structure? So we have different postulations. We have the traditional theory, we have the M&M theory. I've spoken about the traditional theory in my previous video and also the M&M theory in one of my previous videos. But still on M&M theory. Was stated in the last video on M&M theory of capital structure, where he said that there will be no the cost of capital and market value of the firm remain constant throughout all degrees of leverage. I said that the M&M theory challenged the traditional view as to the effect of leverage on the cost of capital. That it developed a behavioral justification support for the net operating income approach, which I've explained in the last video. If you have not watched the video, you can just scroll down and see the video on M&M theory. So, where I introduced the M&M theory of capital structure. So, you know what I'm talking about there. So, in continuation from the last lecture, in the last lecture I said that M&M argued that without taxes, the cost of capital and market value of the firm remain constant throughout all levels of degree, all degree of leverage, throughout all degrees of leverage. Now we have different degree of leverage in the sense that no matter the level of leverage, that is debt, that you have in your capital structure, the market value and the cost of capital remain the same if there is no tax. Please note that if there is no tax, M&M said the value of the company remain the same, irrespective of the level of gearing of the company. Okay, having said that, now let's look at the formula that M&M postulated that we are going to use to solve the cost of equity of geared and that of ungeared. Also, how do we now solve for WACC? And what will now be the value of a geared company and that of a ungeared company where there is no tax? So, M&M started to analyze the capital structure decision within a simple but unrealistic setting that ignored taxation. So, we are talking about where there is no tax. So, but what M&M are trying to do, of trying to postulate a proposition where there is no tax, is that they wanted to avoid a situation where the tax treatment of interest payment, which attracts tax relief, is different from tax treatment of dividend, which do not attract tax relief. So what I'm saying is that there are different ways in which we treat taxation for debenture and for what? For debt and for what? And for equity. Taxation under what? Debt is treated as what? As tax savings. Because we will have removed the interest on what? On debt before the income is what? Is subjected to VAT. But the tax on what? On equity, on the dividend, is not what? Is not removed before you subject the profit of the company to tax. So therefore, when there is no tax now that's what M&M are trying to do, to make reckon with. So M&M proposition without tax. Let's now look at it without tax now. what we now do or tends to do was to, how do we now calculate the cost of equity of what? Of Z. So this is the formula they gave for computing what? The cost of equity of Z. KEG, which is what? Cost of equity of Z. KEG is equal to KEU plus, open a bracket, KEU minus KD, close the bracket, BG all over BEG. And what does all this stand for? It's very simple. Just look at it. KEG means what? Cost of equity of a Z company. Cost of equity of Z. Simple. Cost of equity, K stand for cost of equity of what? Cost of equity. K stand for cost of equity. E is equity, Z is Z company. While KE is cost of equity of on Z company. This KD here, cost of debt before tax. Cost of debt before tax. Where VG, value of what? Value of Z. So VEG, value of this value of what? VEG, value of equity of Z company. VEG, value of equity of what? Of Z company. So that is what the M&M gave as what? As a definition, as a formula for computing the cost of equity of what? Of Z company. In that wise, therefore, having said that, so, okay, the formula here is VD, sorry, as a mix of here, this VD, yes, value of debt. So value of debt, when I say value of debt, it means what? Value of, when there's debt, that is the company value of debt. The company that has element of debt in it. So value of debt, that is VD, value of debt. VD here, this VD is what? Value of debt, not VG, rather. VD here is what? Value, here is VD, not VD. So value of debt, value of debt. So VEG, value of equity of Z company, value of equity of Z company. So this is the formula for computing what? Cost of equity of Z company, as postulated by M&M. Here, so cost of equity of an Z company, cost of equity of on Z company is equal to profit before tax all over value of equity. Where VEU is what? Cost of equity of on Z company all over value of equity in an on Z company. So this is the formula for computing what? Value of equity of on Z. Value of equity of on Z company. YB is the value of equity in an on Z company. God is on Z. So value of equity in an on Z company. There's no element of Z here, on Z, we are calculating for Z here. Why this one we are calculating for Z? So that's why we have value of Z. And value of what? Value of equity of Z. So value of debt, value of equity of Z. So the third one is what? WACC. WACC is what? Weighted average cost of capital of Z rather, equals to what? WACC of what? Of on Z, where there is no tax. Why what? VG, value of Z equals to what? Value of on Z, where there is no tax. So that is our postulation, and we shall see, we shall come to a point whereby we are going to exemplify this we have been talking about Z and on Z. We shall exemplify this formula we have given here to now see what they mean by value of equity of the Z, cost of equity of Z and that of on Z and why. So here, that is what it meant by saying that if there is no tax, the value of what to of J company is equal to the value of J. So at this point, we're going to call it the class now. So at the next point, I'm going to show us how to do what the formula given by M&M where there is tax. This is where there is no tax. Next video, we shall examine where there is tax. So thanks for listening and God bless. Please, if you have not subscribed to this YouTube channel, kindly click on the subscribe button. Subscribe and you'll be glad. And besides, if you have any comment, kindly go to the comment section. I'll be very glad to receive your comment, and I will respond to your comment appropriately. I'm very open. Please put in your comment. Tell me what you want me to do, what you want me to add to the video, and I'm very glad to oblige and respond to you appropriately. So thanks for watching and God bless.